The government announced yet another measure to take more of your money. I'm talking about the increase to capital gains tax. In the government's view, this change will impact only the wealthy amongst us. But you may not be entirely protected. You could face the impact of this change when you have a large one-time event, such as tax realized at the time of death, selling your second property or gifting it to your children, or a large sell-off of shares in your non-tax sheltered accounts. You may be unfamiliar with the term capital gain. So let's briefly recap what a capital gain is. The easiest way to describe it is, say you bought $10,000 of a certain stock and it increased in value to $20,000. When you sell that stock, the capital gain is that extra $10,000 of profit you made. The types of investments where you would most likely be dealing with capital gains are stocks and second properties outside of the home you live in. Remember, your primary residence is exempt from capital gains tax. So what is the change? From the previous example, you made $10K in profit on the stocks you sold. Right now, you pay tax on 50% of this profit. So $5K would be taxed. The new rules come into effect on June 25th, 2024. This will increase the 50% to 67% on profits in excess of $250K. The actual tax rate is not increasing, but now you have to pay tax on a larger slice of your profit pie. $250K is a large number, but there are certain one-time events that could put you over this. Let's say you live in Ontario and inherited a vacation home, like a cottage, 2 decades ago from your parents. The property could have gone up in value by about $500K. That's not unheard of, as property values have skyrocketed over the last couple of decades. Now let's say you sold a property and collected $500K in profit. Under the old rules, you would have been taxed on 50% of $500K, so $250K. Now with the new rules, $250K would be included at 50%, and then the remaining $250K would be included at 67%. So now a total of $292K. A larger slice of your profit pie would be added to your taxable income as opposed to $250K. This $292K number would automatically bump you into the highest tax bracket of 53.53%, resulting in an extra $22K of taxes. This is assuming you don't have any capital losses or tax deductions to reduce your taxable income. Now we come to death and taxes. Perhaps the most significant potential impact of this inclusion rate may be felt when you are no longer around. As Benjamin Franklin said, in this world, nothing is certain except death and taxes. A major concern for older individuals is that at the time of death, your investments outside of tax-sheltered accounts are essentially sold and tax is realized. Estate planning is when you list out what you want to happen with your money and property when you are no longer around. It ensures your loved ones are taken care of. Most property and investments gifted, transferred, or left in an estate to anyone other than your spouse or common law partner triggers capital gains tax at the time of death. These assets are considered disposed of or sold when you die. This means that if you have sizable investments that have increased in value over time, the day you die, your estate will have to pay tax on 67% of your profits above $250K. Another situation where you could be impacted is in retirement. Say you have a large retirement savings outside of your RRSP and TFSA. In retirement, you may want to get some of this money out to fund your living. If you sold a large chunk of your investments in one tax year, this could put you above the $250K threshold. According to the Globe and Mail, if you have time on your side, the simplest strategy could be to sell your assets over the course of many years so that your profits remain under $250K. You could gift, transfer ownership, or sell your assets prior to the June 25th deadline so that anything above $250K is included at the lower 50%. It's worth noting that the capital gains tax inclusion rate has moved a lot in previous years. It was 75% for about a decade in the 90s. So you could wait and see if the inclusion rate may change after the federal election scheduled to take place in 2025. I hope you found this helpful. You can learn more about how capital gains are taxed in Canada by watching this video here. See you on the next one.